All right. What's up, guys? I hope you're doing well. James here from jamesdforsythe.com. So, normally when a new Fed governor comes on, they generally come in pairs, right? Because you got the every 2 years and so on, right? So, we talked about the last one, which is Fed Governor Jefferson with, I already forgot which bank, but the other one, and she also gave her first speech a couple days ago as one of the governors, right? And so her name is Lisa Danielle Cook, and she's with the Federal Reserve Bank of Chicago, it looks like now, right? And so basically, her speech was mostly about her economic outlook, kind of like an introductory, like this is who she is in a way, not really like, my name is blah, this is what I do sort of thing, but kind of giving her point of view so that people are kind of aware to the new governor, right? Or at least one of them. But with that being said, going right over to the speech, right? And so she uses a lot more data than the other guy did, like actual statistics and stuff, which, like I talked in the video going over his speech, it's nothing against him per se. It's just kind of a statement of fact that he didn't really have any statistics in there, which is fine, but just saying, sort of thing. So, again, she will begin with the labor market, which is very strong, which is what you hear every single time from them is the labor market is very strong or some variation of that. So employment rebounded much more swiftly post-pandemic than it did during previous recoveries and has continued to grow at a rapid pace of about 440,000 jobs a month so far this year, right? So you have to kind of keep in mind again, those aren't necessarily new jobs, and I did a few videos on this kind of stuff in general quite some time ago, basically showing per sector there was only like one sector to where the jobs had come back to above pre-pandemic levels, right? Even with all these citing increases and stuff that they were even with all these increases that were being cited in like every speech you could find, um, and talk about like the strong labor market because of the growth and everything. But it's also like when you look at absolute numbers, the jobs weren't there, right? It's just something to keep in mind. It's you can't just look at the statistics, especially like rates and stuff, and just assume because it's positive that's good, right? And an aggregate total over all indicators, whatever, all data. That's what I'm saying. There might be specific ones you want to argue for. That's not really the point. I'm kind of making a generalized statement, right? And using this as an example of something contrary to that, because, like I said, I think only one sector when I did that video had reached the same level as it was before the pandemic, and that was it, right? Everything else was below to varying degrees, right? So to continue, the unemployment rate at 3.7% remains very low, and despite a large drop in the number of job openings in August, which may suggest that labor demand is moderating, there is still an unusually high 1.7 job openings per unemployed job seeker. Meanwhile, layoffs are near historical lows and quits rate is well above the pre-pandemic levels, even as it has moderated somewhat, indicating that workers still feel confident they can find another job, right? So, really kind of talking about how the labor market is more leaning towards labor rather than the actual businesses themselves in terms of who has leverage. And you can kind of see this, I think, um, kind of citing the previous video with the previous speech from the Fed Governor Jefferson, um, talked about kind of salary compression to where when the people are jumping between businesses or companies, whatever, to basically this whole transferring jobs, finding another job doing the same thing, just working for someone else, they're able to get a higher wage because it's easier to kind of butt into that higher wage when it's a different company, right? Rather than like kind of arguing your way, so to speak, for a higher wage within the same company, right? Now, you probably shouldn't be arguing it, but that's a completely separate topic in terms of kind of the ins and outs of negotiation that you kind of have to look into. But regardless, that's kind of where they're going. And again, Keep in mind that in March 2020, for obvious reasons, everything kind of tanked, especially in terms of the labor market, because, when you have a countrywide lockdown in multiple industries, you get that, right? So everyone kind of stops working. So, on the supply side, labor force participation has recovered more slowly than expected and has largely moved sideways this year, even after a welcome rise of 62.4% in August. Keep in mind that's coming after that very, very low base, what was happening during the pandemic and everything, right? So, people coming back to work, it gave a rise of 62.4%. And this is attributed to early retirements prompted by the pandemic have not yet been reversed. Now, the early retirements, depending on, there might be some reversal in that. I could see it, but it also kind of depends on how well off they were beforehand. And you have to really kind of pay attention to asset prices in that form of, or in that respect, right? Because especially if you're a retired person, it really depends on what you have set aside for retirement and what you're using as that, right? If you're doing it, if you're basing your retirement off of the valuations of a portfolio, and then all of a sudden those valuations start crashing, or for whatever reason, or coming down at least, you know, then you might reverse it. But if it's based off of the cash flow, you're depending on how you set up your portfolio, then there's not, and the cash flow isn't hindered by just a nominal decrease in prices, then you don't have to reverse your retirement whatsoever, right? And they also brought up the argument, she didn't, but I believe Governor Jefferson did, about basically people, for caregivers and stuff, taking care of like family members and that sort of thing who became ill in the past few years, that sort of thing. But regardless, to go on to the next topic, which is inflation. So, data over the past few months has shown that inflationary pressures remain broad based, right? So it's you have the CPI, and we all know it's like a basket of different kind of sections of goods and services that you can have. And so basically the each section, or not, I don't want to say every section, but by saying broad based, they're talking like the vast majority or a very broad selection of those baskets are still increasing, right? In terms of adding positive kind of sway into the CPI and PCE, right? So much of the surge of inflation over the past years was rooted in the incomplete recovery of aggregate supply from pandemic related shutdowns. Global supply chain disruptions have especially wide reaching effects, right? And so that's one thing. And I read an interesting blog post, I think, from, I believe it was the New York Fed's blog, where they actually had, there's one to, it's like the GSCPI, which I did a couple of videos on. It's like the Global Supply Chain Pressure Index, I believe, off the top of my head. So you can find those as well. I'll try to put a card at some point in the video, and so you guys can actually see that and stuff, right? And that one was pretty interesting. It had an interactive chart, so I'll actually write down when to put it in so that you guys can find it. And so there's that. Also, the whole, let's see, surge in inflation. Oh, the supply side factors of the shutdowns, right? So, what do you expect when you shut everything down, or at least a lot of things down? Is there's going to be massive supply shortages. And now there's a few things to where a lot of this isn't necessarily just pandemic related, right? It's like you have, especially with like oil and gas and kind of the commodities in general, depending on where you're looking. And the whole point of this video isn't to go specifics, but it's kind of to point out that if you want a more accurate picture, especially from the supply side of things, you have to go into the nuance to a more significant degree than most people do, it seems, to really kind of understand, where is there not enough capex, where are funds not going, so you have undercapitalized companies or industries as a whole, to where they're not investing for the future, like they're not drilling new holes, they're not doing air wells, they're not they're not doing this sort of stuff to basically keep it going. And also, where are the incentives for those industries in general, especially bringing up fossil fuels when you're basically told, that your whole business model is going to be obsolete and basically shut down in 20 years or whatever insert country year that they have. um, why would you invest that much further into the future, even when things aren't transitioned all the way? And yes, I'm talking about the green transition or whatever you want to call it, basically transferring or transitioning from fossil fuels to green energy, right? And the whole point is not to basically bring that, not to negate or basically talk negatively about that transition, but just kind of bringing up is like, regardless of your opinion, this is a fact in general. You have to transition into it. And now, if you're not fully transitioned, why would you take your base out anyway? Especially with how complex energy is in general, especially with global supply chains and all of that sort of things. So a kind of unfortunate tangent, I guess I should say, but keeping in mind that's the stuff you have to get into the nuance, and it always kind of irritates me when people don't and they make these broad blanket statements. And again, this is not topical to her speech. It's just kind of, I made a slight detour, so I'm not attributing this past couple minutes of this video to her speech specifically. Not kind of doing that, but anyways, so to continue, supply bottlenecks appear to be easing, and the global oil and commodity prices have declined. This largely reflects worsening global growth prospects, notably in Europe, right? And so, keeping in mind, so supply bottlenecks appear to be easing. However, global oil and commodity prices are declining, right? And so you'd say, okay, well, if supply is increasing, everything's decreasing. Like the prices themselves are decreasing, right? So, but there's also the whole demand side of things too. And you have to look into the future and that sort of thing. And again, worsening global growth prospects. So you're looking at increasing supply, or at least the trend. I don't want to talk about because it seems like it's a bit of a hot topic, and I haven't looked into very nuanced data on it specifically yet, specifically with oil, but basically from this statement and from this speech, basically you have increasing supply with decreasing demand, hence the fall in prices, right? Which was made me very surprised when I came home from working out of town for a couple weeks and gas prices actually had a two handle on it for the first time in since I can remember living here. Now granted that was just under a year ago, so keep that in mind, but still, right? So, attributing that, U.S. gasoline prices have fallen more than $1 per gallon since June, reflecting the fall in oil prices and refinery margins and helping to slow down the monthly increases in headline consumer prices. I like how she has to add refinery margins, right? And not just kind of, it seems like it's almost subtly kind of alluding to the whole big bad business stuff, right? Um, which I guess I'm not really trying to I don't want to go down that rabbit hole right now. So we're going to leave that off for a bit. So, however, core prices, those excluding food and energy, have continued to rise rapidly. In particular, inflation in core goods prices has been surprisingly strong, in part because the elevated demand for goods we saw during the height of the pandemic has taken longer to abate than previously anticipated. Right? So that's a problem. I'm surprised she didn't say excluding volatile food and energy prices or something along those lines, because it basically always has the word volatile when you talk about food and energy in the CPI. So I don't know if it's almost like it's meant to decrease the amount of weight given to the like that version of the CPI, um, because it's higher or something. But I don't know. Yeah, whatever. So overall, a broad range of goods have seen declines in supplier delivery times and freight prices, and core import prices have fallen in each of the past 4 months, driven by lower commodity prices and an appreciating dollar. So import prices are getting cheaper, right? And so do you really especially in terms of commodities. I guess you could attribute that to the well, obviously you could attribute that to the decrease in commodity prices, but to what degree do you also attribute it to an appreciating dollar? Just looking at the DXY, right, which is a applicable um, measure for imports and exports, right? Because you have to keep in mind that the Dixie is the measure of the dollar's quote unquote value, basically, against a basket of other currencies, mostly the euro, yen, and a few other ones, if I remember. So it's like you have to keep that in mind. It's the basket of currencies, right? It's not like necessarily the over encompassing value of whatever. Like it's not the dollar has some intrinsic value and that's what they're measuring. It's relative to what, right? That's like when you and if you think about it, whenever you're looking at commodities, you're always looking at it with respect to the currency it's denominated in, whatever chart you're looking at. And I guess gold would be a good example right now, to where gold denominated in dollars hasn't been doing too hot. I'm pretty sure it's been falling to a significant degree, if I remember correctly. But with respect to other currencies, it's been doing really well. I actually think it has a positive return relative to other currencies, or I'm sorry, denominated in other currencies, right? For the past 6 months to a year or so. And that's kind of vaguely remembering from podcasts and stuff, right? So keeping that in mind, you have to keep in mind this relative game that everything is a part of, especially with fiat currencies, right? Okay. So to continue, so consumer prices continue to rise rapidly over a broad range of services as demand for services recovers. Continued strong wage increases will likely put further upward pressure on service price inflation. Housing services inflation will likely boost overall inflation well into next year, keeping in mind that I think I think it's exactly a third. It's like 33% of the CPI is home owners equivalent rent. I think, or just owners equivalent rent, which now if we want to talk about if that's an accurate measure of housing prices in general, I think it's very arguable, but it's literally a third of the CPI, right? Unless they change the weightings in the past few months, right? Which I wouldn't put it past them because they have done that before. But regardless, so although rent increases on new leases are starting to slow, that moderation also is likely to have a substantial and uncertain lag before it appears in the PCE, right? And the CPI, excuse me, keeping in mind. So, also kind of, I guess, speed things up, talking about rate hikes. And so you basically have been seeing broad based monetary policy tightening globally, right? And so central banks around the world are pretty much all tightening monetary policy, right? In some form or fashion, mostly interest rates, to rein in domestic inflation. And that's obviously with respect to their own economies, right? Domestic with respect to them, right? But, and one thing that she brings up is they have to keep in mind that it's really the cross-border spillovers that could happen from this, right? And so if you have, especially take example the dollar, with the Fed increasing interest rates, tightening monetary policy and stuff like that, some people it seems would argue that that would be one reason for the increase in the dollar on the DXY, and therefore it basically these spillovers would be how would that affect foreign countries with respect to the United States? How would it affect their business, specifically exporting to the United States, right? And so basically, they're receiving less dollars for their what they're exporting there, right? Because the dollar is worth more, and so it's be more expensive for them to send it here. I probably switched that around. I'm not the best with foreign exchange and that sort of thing yet. Still something I'm working on. But anyways, so her main point for this is that basically all the central banks are doing is looking at their domestic economies, right? And so that's really what their main focus is. And as she says explicitly, my being this new Fed governor, her role is to focus on the Fed's dual mandate to promote maximum employment and stable prices for the American people, which is a domestic mandate, right? But you still have to be, and she says this later, that they're still cognizant of how that's affecting other countries. I'm pretty sure, is it may have been the Bank of England or I think even the UN, but that would have just been a headline that I grazed over, right, at some point, basically more or less begging the US to stop raising interest rates, right, for their point of view. But so put a little bit of weight in that, or not very much, but kind of going into more of her specific policy outlook, I guess you could say. She does have experience on the Council of Economic Advisors. And so this was during the eurozone crisis with emerging economies, particularly Russia and some African economies, and basically talked about how it can be difficult to forecast in highly uncertain environments, and also the how little standard models can help for those situations, right? And so then she begins to talk about more timely, high frequency data and not necessarily their traditional data sources where it's all like seasonally adjusted and that sort of thing, right? Looking at other things to that maybe aren't necessarily pristine from an academic sense, but still applicable and help kind of sway policy decisions, maybe to kind of get a more accurate and quicker way to make decisions, right? And things that she gives examples as are wholesale used car prices, rental rates on new leases, and then supplier delivery times. Also, real time information, which this kind of I was surprised because I didn't know they had this kind of stuff, was Google mobility data and open table data on dining reservations. So I didn't know they had access to that. I mean, I guess it makes sense from their perspective, but I don't even know. Open Table was capitalized, so I'm assuming this is like another company or app, kind of like Google, but obviously not to the same extent. But I don't know. I'd have to look into that more because I don't know what Open Table is. But apparently, they receive or congregate data on dining reservations, and the Fed has access to that, right? And so basically, they can try to use this and these new kind of high frequency data sources to reduce the lag between when they hike rates or try to tighten financial conditions and what's actually happening in the real economy, right? So basically, I guess reduce the time that the Fed's behind the curve, so to speak, because they really don't want to make mistakes. So there's that, and kind of the time, all these different things lag monetary policy to different degrees, right? And so, I mean, I can see where it's arguable that it's like these aren't necessarily affected by monetary policy. I think there's an argument for some of them in that respect. Some of them are obviously more directly related, but you just kind of have to keep it in mind on a kind of indicator by indicator basis, I guess. Right. Specifically, she brings up residential investment, which with mortgage rates and that sort of thing, obviously that's a lot more directly tied to monetary policy. Specifically, like with QE and that kind of things, when the Fed buys mortgage-backed securities or doesn't buy them at all, like they are now, that sort of thing. But just keeping that in mind, right? And so, kind of to conclude, right? And so she thinks it is critical that we prevent an inflationary psychology from taking hold. This is not simply an abstract concept, but a risk she takes seriously based on personal experience. And her time doing dissertation research in Russia in the mid 1990s taught her just how disruptive and painful an extremely high inflation environment can be. Right. So, really, the whole playing on inflation expectations, right, is kind of where that's going. And so the whole, which is something I've talked about a few times, right? Basically, with when you see that change in psychology and people start basically buying everything they can to because they think the value of the currency or is depreciating, or they can they think the prices of what they're buying is are going to increase before they're able to buy it the next time, they'll buy more, right? And basically hoard goods and services because they're transferring are basically value from a currency that they think is worsening to something that actually matters, right? Like goods and services. So again, that's kind of just a superficial comment on it, not necessarily something very in depth, because that's not the point of this whole video. But yeah, basically, that is the introductory speech for the new Fed Governor Lisa Cook. So yeah, and this one does have a watch live link that you guys can actually watch it if you want to, and actually see her speech. I'm assuming I didn't click on it because I prefer to read them, but still. Anyways, I'm going to leave this one here. So I hope you guys have a good night, and I will see you on the next one.